The Australian All Ordinaries Index slides, market volatility is on the rise, and the ACCC blocks the proposed Vodafone TPG merger. Hello and welcome to this week's Australian Stock Market Report. I'm Dale Gillham, the Chief Analyst at Wealth Within. Now, before I get into my thoughts on the Australian share market, firstly, I would love you to hit that subscribe button and click the little bell on the right of it so you keep up to date with our latest video. Also, remember to tune into our live Australian stock market show every Tuesday, 7 to 8 p.m. Australian Eastern Standard Time. This is the show where you get to ask me, the expert, to look at your favourite stocks and ask your questions. Uncertainty among investors has heightened over the past few weeks. And when the market is uncertain, volatility rises. This heightened market volatility comes as no surprise, as volatility always increases in reporting season. Market volatility had been consolidating sideways for a period of time and was low, which is a sign that the market direction will change. The All Ordinaries Index has closed lower for the past 2 weeks and volatility has risen, confirming the change in direction. It's also not surprising that volatility is higher, given that we're approaching a federal election. And as with all elections, many are speculating about what the market will do if the government changes. On top of the election and reporting season, we also have the Reserve Bank's unexpected decision last week to keep interest rates on hold rather than reduce them. The RBA met last Tuesday and, despite pressures to cut interest rates, held them steady at 1.5%, which I believe is a wise move prior to the election. Now, maybe this is a good sign for the current government, given that the Reserve Bank reduced rates just prior to the last 2 changes in government. Now, speculation is ripe that the Australian share market will fall heavily if the government changes on election day, but attempting to determine the direction of the market based on an election result is a waste of time, in my opinion. No government has the ability to affect change in the overall direction of the market quickly. On top of this, our market is currently considered to be bullish, and I believe will continue to be so in the medium to longer term, no matter who is in power. As I alluded to before, what is important to consider is investor confidence in our market, and it's imperative for either party to instill confidence around the globe in our ability to be strong economic managers. Our market benefits greatly from foreign investment, and in order for that to happen, there must be stability in our economy and confidence that our government is stable. On other news last week, the $15 billion Vodafone TPG merger once again come under fire from the ACCC. Rod Sims, the chairman of the ACCC, expressed concerns about the over-concentration in the industry, which he claims would be detrimental to consumers. Seriously, I believe this merger will be a good move for telcos, as it will lead to more competition in the industry, not over-concentration, and challenge the current Telstra-Optus duopoly. And this will ultimately open up more opportunity for better pricing and better services for consumers. It's no secret that Australians are overpaying for telecommunication services, yet we're experiencing lower standards in the delivery of these services than many other countries around the world. The NBN rollout is just one example of paying high fees for a poor service. An interesting play last week came as Treasury Wines was heavily sold off after accusations by a US fund manager for overinflating sales figures. At the same time, the CEO sold off some of his shares, which resulted in the stock being down as much as 12% last Wednesday. What was interesting to me was that the US fund manager has a short position in Treasury Wines, and you have to question the intent of the speculative accusation. It is possible this could be a stunt by the fund manager to manipulate the stock price in their favour, as the timing and the details of the accusation are interesting. Whilst most of the market was in the red last week, the utility sector was the best performer, up around 2%. The worst sectors were consumer staples and information technology, which were down 2 and 3% respectively. Of the top 200 stocks, Domain rose over 10% to trade to its highest level since October last year, despite being one of last week's worst performers. Northern Star also reversed its fortunes, up over 8% last week. Now, the worst performers in the top 200 were Adelaide Brighton and GrainCorp, which were both down over 14%. So what do I expect for the Australian stock market? Well, let's go and have a look at the charts now.
Please remember that this report is an educational tool. While Wealth Within holds an Australian financial services licence, the information featured in this program is general in nature and therefore should not be relied upon. Before making any investment decisions, you should consult a licensed professional who can advise whether your investment decisions are appropriate for you. We hope that you enjoy this week's report.
Okay, so hasn't the election been an interesting watch? And I know a lot of people out there, as I mentioned, are talking about the election, and I'm getting emails about that, saying how, the market's going to react after or during the election or after the election when the government possibly changes and everything else. But again, I really don't think that's been a big worry. If you're looking at the screen right now, you see a weekly chart of the All Ordinaries Index. If the big marketplace was worried about it, you'd already been seeing the market falling away, not just for the last couple of weeks. You would have been hearing it or seeing it fall away for the last month or 2 months as they start getting out. If there's really that much worry, because as individuals, we don't control the market that much. The big end of town is the biggest buyers and sellers of stocks, and that's around 75% of the market is traded by institutions. Your superannuation funds, your big managed funds, your big broking houses, all of those sorts of places are doing the bulk of the buying and selling. So if they're worried about it, you'd already see it on the chart here. So if you look at this chart, this is a weekly chart. You see our market opened there at 6427. It pushed all the way down to 6327. So, there we're talking about a 100-point drop, or 99.9 points exactly. And then it came right back to close at 6393. So that was showing a lot of strength. If I go onto that daily chart, and you'll see what I mean here, it sort of fell away earlier and then came right back the last 2 days. If the election was an issue, because it's this Saturday, then we would definitely seen a bearish move on our market, and we're just not having it. This is just normal stuff that our market is making a normal adjustment, which it does. It's possibly going to go down again this week. Now, I've got on the screen there, you can see here the target of 6228. And then 6096. So, but interesting, I've left that the blue line there. Remember a few weeks back I was talking about all this sort of consolidation across that green box, all the opens and closes through there. Now, it wouldn't surprise me if it came right back to that sort of level there, which is 6279 or 6286 at that particular point. So it wouldn't surprise me if we had another week down. But again, it wouldn't surprise me if our market went up. If our market goes up now, then it's going to be really, really nicely bullish through into sort of mid-June-ish, maybe late June, and come down into July. We might get another week down before we then move into June and then come down into July, possibly early to mid-July. We might come down into another low there, because our market is very, very repetitive in exactly what it's doing, but it is looking quite nice at this point in time. Now, let's go into the stocks. Now, while I go and find the stocks, we've had a few questions at this point in time. The first one was from Ashwin, and Ashwin's actually said he's asking about a US stock, and I've had a few more questions about US stocks. Normally, I'll be putting that in my US report that I do every week, but from this week, my US report has changed. I'm now being syndicated on a national syndicated radio channel, so over 25 stations across the US every Monday, which I'm recording with a gentleman called Jim Beach, and you'll see that come up tomorrow on Tuesday here in Australia, which is recording for Monday, the video of Jim interviewing me. That's going to be my new US report. We're talking about the US market and other things about business and the economy, those sorts of stuff. So watch out for that. It's a different style next week. So I'm putting this stock in here for Ashwin. Ashwin says, I was wondering, what do you think about Exxon Mobil stocks? Apparently, they've recently discovered a huge oil reserve. And when I read stuff like, they've got a new huge oil reserve. Now, we will look at Exxon Mobil. I'll just bring it up here, and you can see the stock itself on the right-hand side. In the monthly chart, and on the left-hand side, a weekly chart. And you can see, basically, my answer to this, Ashwin, is if you know about it, then the big end of town's already known about it for a long time. So, and at the big end of town, as I said earlier, they direct the market. They push it up or they pull it back down. So I don't really necessarily think anything about ExxonMobil finding a new huge oil reserve, because whether they make money or not depends on the oil price and obviously the demand for oil or whatever it is. Obviously, currently at this point in time, the Northern Hemisphere is in summer, so there's less drain on oil reserves when that happens. When they move into winter, a lot more demand for oil supplies when the Northern Hemisphere is in winter. But again, the share price here says to me that it's not a big issue. It's not really going to go through the roof just because it's found some oil. And it's the same thing with a lot of miners. People say to me, hey, they're going to drill. They're finding gold, or they're finding lithium, or they're finding something else. So they're going to go through the roof. Not necessarily that's what's going to happen. It's the chart will tell you exactly what's going to happen. So this stock is really bearish at this point in time. And you can see here its all-time high was back there in about 2014. So right now, I wouldn't be buying ExxonMobil stocks, but it doesn't necessarily mean it's not going to go up because it's found oil reserves. But at this point in time, it's not something that's super exciting to me in terms of something that I would actually buy. Even if it was an Australian stock, I still wouldn't do it. The next one we've got was from Matthew Kennedy. Now, Matthew says, thanks, I'll buy the book. I think I've answered something for him last week. I'll buy the book. I was lucky to buy Alumina at the right price. Capital gains have approximated my capital gains from ResMed is looking at there over about the same period. The dividends currently 14% are a bonus, but like you say, I can only control when I buy and sell. That's absolutely correct. You can only buy and sell. You can't do anything else. The market determines what kind of return you're going to get. Returns looking good until I looked at something like PPK and Z1P. So I'm just going to look at Alumina, and this is where, and I'm going to look at ResMed here for you. The simple thing is you can't look at returns like that. PPK and Z1P, they're speculative buys, or they were speculative buys. You just can't compare that. And in a minute, we'll look at Macquarie. Macquarie outstripped all the major banks. They were going down. Macquarie's going through the roof. But what happens is you get a changing of the guard. So where stocks will go up, like a Z1P, it'll slow down and other stocks will go up. So you might find Alumina will start taking off like a rocket, or you might find ResMed's done very well in terms of in that healthcare sector. It's done really well, and we'll look at that in a second. But if you look at Alumina, it's fallen since that high back there in, what is that one, October 2018. So it's been falling for the last 6 months, but it doesn't necessarily mean it's going to continue to fall. If it finds a higher low than this, at the moment we don't know. So there's the December low. It went off really well. It came back, but look how it's closed higher. Now this could start taking off again. So to me, it's about having a nice balanced portfolio. When you read my book, you'll see about how to balance out that portfolio, how much you should have in bigger stocks, how much you should put into speculation. Too many people put all their money into stocks that are lower capped, and you only have to watch the live show to see how many people pick the worst stocks on the marketplace. And again, I think I said it a couple of weeks ago, those with the least amount of knowledge pick the worst stocks. Absolutely the worst stocks. Those with the most amount of knowledge and experience pick the best stocks. And that's the reason why people like myself make a lot more money than people without the knowledge. So don't tend to follow that herd. If you go and follow that herd into things like Z1P, you'll get it wrong a lot of times, because most of the amateurs are buying at the top and the professionals buy at the actual bottom. But this is looking all right. Alumina, if it starts moving up from where it is, I think it'll do okay. Now looking at ResMed, look at ResMed, beautiful stock, and it's looking super bullish. So I wouldn't say that that going to these other stocks is a better idea, or comparing it's not a great idea. As long as you're happy with the returns, that's really the major thing you need to look at. But right now, ResMed is bullish. It looks like it's going up. It looks like it'll get into a new all-time high. I like the healthcare sector in general. I like CSL and Cochlear and those sorts of stocks at this point in time. So it does look really good. Now we've got a question on Macquarie from John Smith. Now we're going to take a look at Macquarie. As I said, it was outperforming all the banks, and he said, can you just look at Macquarie for me? Absolutely, I can do that for you. And looking at Macquarie here, it is bullish. See, look at that massive move. Now, if I go and use my little tool here, my price range percentage tool, since 2011, this has moved up. Look at that, nearly 600% since 2011. Let's go to the GFC. So now here we're looking at, where's the GFC? Oh, that's after the GFC, sorry. In the last, since 2016, the last 2 years, 134%. So it's doing really well. And right now, it's been a little bit bearish the last 2 weeks, but I wouldn't necessarily worry about that. It's just a bit of an adjustment. It looks a lot worse on that right-hand side than it does on the left. When you look at the bigger picture, it's a lot less scary. in terms of that. Too many people look at what's going on during the day and everything else. So, but Macquarie does look really, really good at this point in time. One more question I've got. Somebody, who was it? Cameron, I think. I can't read my screen properly. Cameron said, great video, mate. Thank you. Thanks for watching and being part of that channel, or our channel. If I'm looking for a safe blue chip to purchase with a small chunk of savings, I am looking for a safe blue chip to purchase with a small chunk of savings. Already have the two big banks, two biggest miners. I'd say obviously two banks, probably Combank is probably one of those. The other one might be Westpac, but if it's not, but that's okay. But I'm not sure why you'd have the two big banks, because they've been falling for the last 4 years, but that's okay. Biggest miners would be BHP and Rio, my guess, CSL, Woodside, Telstra, and 3 managed funds, and up 20% since 2014 overall, but actually have no idea what I'm doing. That makes sense. I mean, obviously up 20% since 2014, so it's 4 or 5 years, depending on when you bought, but probably closer to 5 years, I'd say. 20% is not a very good return in the last 5 years. That's actually because you've had banks. BHP and Rio weren't doing that well to a lot more recently. Telstra hasn't done a lot more really well. So I'd say what you're doing is buy and hold. You really do need to buy my book, and it'll sort a lot of that out. But what sort of stock could you buy? ResMed, Macquarie, there's stocks like that. CSL, Cochlear, we've already got CSL, sorry, but there's sort of stocks that you could buy. But buy my book and I'll tell you how to buy, how to sell, and how to manage that portfolio better, because you could be getting at least 20% per annum, not just 20% over the last 5 years, just by using the rules in my book. So get online, get it Amazon, bookstores around Australia. You can get the book, or on our website, wealthwithin.com.au. But if you've got a question for me, please shoot it through. Happy to answer. And if you've got a stock you want me to look at, please do that. But for those of you who will get on Tuesday night, I'll see you there. So good luck, good trading. Take care.